clients are coming to us where they've just been doing everything in the corporate account. So do you want to talk a little bit on why it might make sense to take money out of the corporation and start spreading the wealth across those personal accounts too?
Yeah, that's a really good question. And it introduces, I think, an interesting concept in financial planning, particularly with corporations, which is that there are hard number advantages to things, and then there are sometimes softer advantages that exist too. And so there can be benefits in diversifying your wealth across different accounts. The asset location piece maybe is one of them, but I would suggest the more important piece is giving you access to different pockets of liquidity. Let's say, for example, you pull funds out of your corporation in order to finance TFSA contributions. Strictly speaking, when you do an evaluation of that, it's more of a wash than you might think. You get the TFSA filled up, it is going to now compound tax-free, but you had to pay a bunch of personal income tax in order to get the money into the TFSA. And that money is gone forever. It's paid to the CRA now, and you're not achieving a deferral benefit on that taxable income. But you have a TFSA, which is now going to grow and compound and will be a tax-free source of liquidity if you had an emergency. So, say that you had to have a couple $100,000 quickly, maybe you could take that out of your corporation, trigger personal taxes, trigger corporate investment taxes in order to do it. If you had a TFSA, you're more flexible. You can take it out tax-free and give yourself a little bit of breathing room. So yeah, mathematically, it's pretty tight, but from an actual practical standpoint, there are some soft advantages in our view in diversifying your accounts.